the report got the wheat was the highlight there, but next week they're going to be discussing how bullish these numbers are. But then the next analyst will be saying these are some of the worst numbers we've seen going into spring as far as carryovers go.
Hey, welcome to Hedge Heads, where we discuss the commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. Well, no one knows where the market's going. We're not afraid to share some ideas. I'm Ryan Tunkseth. He's John Prishman. Well, John, we are heading into a Minnesota holiday, which is it's either the fishing opener or it's Mother's Day. I guess it depends on which side of the debate you fall on. What do you have going this weekend?
This year I'm told that both are going to matter a lot. One matters a lot but the other one's going to matter a lot for sure.
Sure. Do you want to say which one matters most to you, or maybe not admit that in case your wife listens?
I think that would be it would be easy to figure that one out.
This sounds good. So, do you have plans for either of them?
Yeah. Yep. Like you, I'm not fired up about the scene on a Minnesota fishing opener. A lot of states have open fishing seasons year round. Minnesota likes to close the walleye season, and although I've been fishing on the border waters, which is open without getting into complicated regulations, the main Minnesota lakes are going to be open tomorrow. It turns into a zoo. I think I'll try to get there maybe when the first enthusiastic group of people that get there at 5 or earlier get off the lake, maybe 2:30, and try my chances later in the afternoon. And if I go, what are you going to do?
I do not fish on Minnesota fishing opener. I avoid the madness. We're lucky enough to have jobs where we can fish most days, and I will save it till a weekday. Although since COVID, even the weekdays aren't like they used to be.
Yeah, we'll see how the experiment goes, but you go roll the calendar over, or the calendar over another week, and everybody will clear out a little bit at least.
Right. Well, that's Mother's Day fishing opener has nothing to do with our podcast. So we actually had a report today, which normally this is not a high expectations report, although today it seems like people had high expectations. So.
Yeah, I don't know what the deal is. I think it goes back to what we have been talking about, that there's just so much information exchanged on commodities so freely now that it just gets this hype. I mean, on a scale of 1 to 10, this is maybe a 2, maybe a 1. The soybeans can be very tight this time of year, and that's usually the most interesting number. Of course, we have way too many soybeans left over this year. So we had the report. It's been hyped up all week, and I haven't understood why. And then the numbers came out, and they almost fell exactly where they thought they were going to be. Wheat being the biggest surprise, under the numbers, corn slightly under the numbers, and then being above the numbers. And I won't bore you with the numbers. I'm sure you will get peppered with them and everybody's opinion on them. You're going to have half the people say this is the best thing they've ever seen, highest numbers you're going to see all year long, and it's only downhill for the crop from here, and it's going to get tighter and tighter. Then the other half of the people are going to say these are the best numbers you're going to see. It's going to get worse and worse and worse. And, who's right, who's wrong? Well, we got the summer weather ahead of us, and that'll tell the tale. Generally, the June report is the monster. At the end of June, that is the one that you should talk about. That is the market mover. Today, the numbers fell where they thought they were going to. The market didn't have much of a reaction. Beans went down immediately after. And then corn went up a couple more than it was already up pre-report. So it ended up having a nice day. It's almost like they knew what the report was. Of course they don't,
Well, the reality though, when it comes to reports is the numbers are the numbers. They will move the market, but what matters is where the market goes. It's the numbers they can say whatever they want to say for the numbers. It matters where the market goes.
Yeah, it shouldn't have a huge impact, really. When we look at the numbers, they're ugly. It's only good in certain categories for wheat. This is a huge carryover for soybeans, huge carryover for corn going into summer. That's probably not what you're necessarily going to read. Everybody just, they put their own opinion on what they mean. And it's kind of a chaotic time of year. A lot of different opinions on what's going to happen. One guy is going to say their fields are too wet and they're never going to plant. It's going to prevent plant. This time last year, everybody was saying there's not enough moisture to even get through June. Everything's going to die. It's different every year. They were in an absolute panic last year. And then, of course, we had a record yield in corn, according to the USDA, of course. And then beans did very well as well. So it's just that time of year where you're going to get a lot of differing opinions. Not much in the report. Again, people will argue with that. Would you say bullish against expectations, which is very tricky wording. Like you can have a terrible number, but if it's not quite as terrible as they thought, that's considered as bullish. Just like the stock market where you have bad data, well, they must have to lower interest rates, thus it's bullish. So you kind of got that going on in grains a little bit. But for me, I'm happy. I have a lot of hedging ideas and opportunities that I feel that I need to get done. So this is very helpful for a person like me.
Well, I would say a day like today offers some great opportunities when you're talking about hedging. So
yeah,
that's what we want to look at.
Yeah, it would have done very few people good if it was down 20 in corn and down 30 in beans before we even really emerge from the ground. It puts you in a very tough position because no one knows what the yield is going to be, and they're betting you that you need to hedge at a low price before you know what's going to happen. So it's good for everybody, I guess, unless you were heavily short going into this, and I don't know why anybody would be. But it was the report. I look forward to the June one, and there's just something off with just the pricing of everything. Like I was looking at the options today, and the implied volatility is exceedingly low leading into a summer.
Especially on the bean side. I have some bean options on, and I can't believe how cheap they are. The volatility is low, and has been for 2 years, to be honest.
Yeah, it has, and it's odd. I mean, implied volatility is basically the estimate of what they think the future volatility of the commodity is going to be, just based on the option prices. So in plain English, this would be, let's say, $12 November beans. I think they were right around there. So you look at a call. I added the call and the put together, which would be a straddle. At the same strike price, it's a straddle. So let's say you buy a call, buy a put, you're long volatility. And so you would look at the price that both those cost, and it's $1.03. So that means the option people do not think that beans are going to move more than $1.03 in either direction, the entire time all the way to the third Friday in October, which is really incredible for soybeans. So the volatility is very cheap. Now, this is not a recommendation to buy or sell that. It's that I'm pointing out it's exceedingly cheap because when you generally price volatility, one side might cost 95 cents in a normal year leading into summer growing season. So really odd pricing on the options is one way to put it. They seem way too low, but I'll get comments like, well, they must know something, and that's why the puts are so cheap, so it must be going higher, which is really just silly. Nobody could possibly know. It's just their prediction when you look at the underlying volatility of the commodity and then base it on those option prices. So it's way off. Somebody's certainly wrong here. Or maybe these guys do have it nailed and we're barely going to move for months and months and months this summer.
Certainly anything's possible. I prefer trading options, so I do watch that volatility a lot. And when there's low volatility, I look at it as there are opportunities to buy options then, because you expect at some point volatility to come up.
Yeah.
When volatility is high, that tends to be an opportunity to maybe sell some options, in my opinion, looking at more complicated strategy-wise. I don't know if you want to dive into something.
Yeah, you're either long volatility or short volatility. So a lot of people think you have to know the direction of the market, not when you're trading volatility. It's if you see it's cheap, you're buying it, and it doesn't matter what direction it goes as long as volatility picks up. So you will make money that way. So that I really like straddles. In front of certain USDA reports, they can be wonderful. Beans are one of the better markets to do that in. And because it's usually mispriced anyway, this time it looks very mispriced. So, and I like the idea that you don't have to know the direction that it's going to go to make money. That's a big plus for me.
Right.
And I don't think a lot of people know that even exists, that these combinations exist. And we've kind of strayed into a lot more, I wouldn't say advanced strategies, but above 101. I mean, these are things that you just look at to try to gauge what the market's feeling on where we might move. Very important stuff as you get into your hedging. This is the kind of stuff that you'll be looking at. You'll be very familiar with implied volatility, especially if you're the type of grain farmer that stores grains and sells options on your grains. You're going to want to know where you are historically versus the 5-year average. Again, all this is just guides, but this is stuff that will be like second nature to you once you start getting into hedging.
Yeah. Talk just a quick review again on the straddle. Now, we can straddle any market that has options, right? I mean, and how does that work? Not that you should.
Any market, dry way might be tricky.
I didn't know they had options on dry way, so
I'm not sure they do. But I've personally definitely been in the futures contract. I mean, you're going to want to watch your bid and ask in that market, and you're probably not going to want to fire market orders in there. But theoretically, I think you can. Strangle is a close cousin of that. It's just different strike prices. So instead of a $12, you might be $11.80 and $11.60, and that's the only difference. It gets really wordy with options really quick. I mean, we are just skimming the top of stuff. Like when you sit in college and you're learning about marketing, you're probably going to hear call, you're probably going to hear put, and then they're going to give you some sort of assignment that probably you can't apply very well in the real world. But anyway, that's kind of how it works learning about this stuff. Or they'll bombard you with about 15 words you don't know, and then you're going to tune out and wait for the free lunch at some point in the near future at the meeting that you're at. So that's kind of what happens with options. It's just like hedging. I mean, you need to learn very slowly. It's a different vocabulary. It's once you get the simple concepts, it's not that complicated. But I feel a lot of guys get caught up in that they get overwhelmed right at the very beginning and kind of give up on it. Or they bought a call and they didn't make money and they give up on it, or bought a put. Something somewhere along the way didn't work out and they give up. But very useful tools, and it's something that we started this conversation with. Is something's not quite priced right, whether these options are right on and I'm way off, that this is going to be a very quiet summer. Certainly possible, like you said, but seems to be some sort of opportunity somewhere along the way here, I think, in the summer in options.
Yeah. I think it's important to point out that kind of knowing what you're trading is important, like you said, with the call and you don't make money, and now you don't want to do a call again, but you don't necessarily understand why. Like, we can help people understand. That's part of why we're doing this podcast, but my dad talks about it all the time. He likes to speculate, do some trades, but he says, I'd do more if I knew what I was even doing. And so it's hard. I mean, options can be difficult to understand, and even some basic things don't always translate.
Yeah, and it's pretty crazy to me that people will jump right on Robinhood, or I don't know, any of these platforms where you can just sign up on your phone and then you dive into this world, and maybe you learned a little on your stock form that you read, or you bought an ETF or something like that on commodities, and then they take the next step and dive into this. That I wouldn't recommend that, but it seems to be a growing trend with the younger crowd, anyways. Where guys my age and maybe a little younger and older like things explained a little bit better to them. These young people, I think crypto just taught them, just dive right in. You'll figure it out. I think when the markets stop going up every day in the stock market and crypto, that probably attitudes will change. I wouldn't recommend doing that in commodities. You need to learn very slow and very carefully over a long period of time, and then you dip your toe in the water, and that's what I would that would be an official recommendation. Take your time.
It's commodities are different in that you can buy or sell at any time, but on top of that, the one-to-one relationship where what you're buying, somebody's selling you, what you're selling, somebody has to buy it. You're jumping in the deep end, so understand why you're jumping in.
Yeah, my mother still has no idea what I do. The stock market will have 1,000 point down day every once in a while, and she'll call and say, "How's the business? How's everything going?" Not understanding that actually down is generally easier to make money than up in commodities, and the direction makes a little difference. The unpredictability of the market probably is the biggest obstacle. But a lot of people are just comfortable with just up and not down because of stocks or crypto or whatever they're in. But in commodities, it's just as easy to be short as long. You do not have to own the underlying asset like in stocks. You have to have that 100 shares or borrow that 100 shares in order to short that. Where commodities, that's not the case. If I want to short corn, 5,000 bushels, and I don't raise a bushel of it, I can. That's where the funds get a hard time, and that they don't own corn and they sell it, but then last 3 years they've been buying it and they also don't need corn. So it cuts both ways, but yeah, just long or short, it makes no difference in commodities.
Well, and we talked about funds in our last episode too, and you bring it up now. The reality is there's not funds in dry way. So try and get your order to move if you're looking at trading dry way or any of these minor markets versus having funds in corn. You can fill an order. Your market order is going to no slippage in general.
For my spreads, I thrive in the illiquidity cracks of deferred contracts. I love that stuff where they can't be, or if they are, they sway it, to a degree where I can take advantage of it. I do enjoy them that way, but yeah, they're not going to step in where, like, you look at the 3 wheat classes, you got liquidity, big time liquidity in Chicago wheat. You have a lot of liquidity down in Kansas, but Minneapolis is kind of that one that doesn't have that. So when the big wheat market that took off in 2008 going into 9, they bought Chicago wheat. As a matter of fact, they got 95 cents ahead of Minneapolis. Minneapolis is a higher protein wheat, so it's like stew meat costing more than sirloin steak. But that didn't last long, and in the end, Minneapolis wheat was, $12, $13 over Chicago wheat, so quite a swing there. But initially, they go where the liquidity is, so they can skew markets, and it might not make sense, especially like wheat spreads and stuff like that, but eventually the market gets back to equilibrium, where the higher protein wheat in shorter supply was, of course, the highest priced one there. So, but they tend to go where the liquid markets are. And if you got a market like corn versus soybeans, look at the Commitment of Traders just came out, and they covered a substantial amount of shorts in soybeans. And it moved the market quite a bit, where they covered a lot in corn, but it didn't move near as much because corn is much more liquid than soybeans. So you just kind of know your markets and how they're going to affect it when the funds get involved. But yeah, they definitely like liquidity, because you can't have an order to buy 15,000 contracts. If they only trade 6,000-7,000 a day, you can't get in those markets. So they tend to stick with deeply liquid markets.
Yeah, I think a good point to that also is that knowing the months that you're trading are important too. I just had somebody who was they had looked at the May hog chart. They wanted to trade May hogs. Well, there's not nearly the liquid in the May contract as there is in June.
Yep.
And so knowing what months you're trading and what months you're looking at and where you want to do is very important when it comes to commodities.
Yeah, I love the May contract because I love the May-June hog spread. It's one of my favorites. But of course, no one else does that. I mean, they think I'm crazy for being in it. But I think I've been in that one almost every single year since the May contract's been around, or near that. So like I say, I thrive in the illiquidity, and that the fact that they don't like it, it gets severely underpriced relative to June quite often. But yeah, you have to know that's where we come in. I mean, you have to know every contract. It's very important in grains, especially when you're rolling contracts at the elevator, rolling basis contracts. You need to know what is supposed to do what relative to history. like the back of your hand if you're going to be an effective hedger. So meaning like when you roll, like when do you roll? When's the optimal windows for you to roll? And if you get those right, you can sometimes pick up 30, 40, 50 extra cents with good rolling. Last year was tricky. Usually the big roll would be December corn to July. It actually went way wider than it would normally go at a way later date. That's not very common, but generally the markets, there's optimal times and there's optimal contracts, and this spills over into options. Which option to buy and which time frames, that's a whole nother episode. I mean, you shouldn't, when you first start, you're not going to automatically know. But again, that's where guys like we come in. We would be guides that would help you try to pick the right time frames and, maximize, like instead of buying a call, May corn call, then a July corn call, then a September corn call, is it smarter to buy one for a longer period of time, or are these shorter time periods smarter this year? Is July corn going to get inverted to $1.20 where that's the one that's going to move, or are we at full carry and it doesn't matter which one you pick? It's just like you can't put this in a textbook because it changes every year. It might change every week. So you just have to get very familiar with the markets and see them move year after year with the fundamentals that are backing them to understand where they belong relative to history. But then you throw the funds in, like you say, and they can really skew that stuff on shorter time frames. But for me, that's where a lot of the opportunities that I like are. If you are in before they do that, that can be awfully painful. But if you let them skew it with them getting in the front, where they like the liquidity, sometimes that creates a wonderful opportunity, especially when you're not watching and then someone points out to you, hey, did you see, this is way ahead of that. And then you're like, hey, yeah, I'm glad that you told me that, and I'm glad I didn't see that a month ago because I would have been way early in that thing.
Right. And that's, from the speculation side, that's something that we do look at a lot as we try and find those markets that are skewed. This isn't necessarily the hedging side, but where is there opportunity to make a little money on something that's off or not normal?
Yeah.
At least look at why it's not normal.
And I think I'm a little odd. I like spreads. I know a lot of guys like spreads, but it's a misunderstood thing. I don't know how people can be in markets without a little bit of an understanding of them. There's quite a bit of information out there, but they somehow fall by the wayside. I really enjoy them, and I think it's extremely helpful for grain marketing. But, it's just one of those things where maybe that's my specialty. You can't know everything and know every market. Like I see on Twitter, there's guys that thrive in the options market, and they talk a different language than I even know. It gets very advanced very quick when you're knowledgeable about your area. So I like spreads. Ryan, I notice he's an option, shorter term options a lot. That seems to be where he likes, you just go where you're comfortable.
Yep. Yeah, and I think that's true. And the more you do something, I like the short term options for the risk profile and finding those opportunities that are not. But I definitely wouldn't recommend somebody hedge with short-term options.
Well, you never know. I'll see certain phone numbers, and I'll know before I pick up the phone exactly what month we're looking at. Like they're just like clockwork. This is what they're going to do. Where the next guy wants some input, another guy might call, and he's always buying time, meaning just longer time frames. So everybody's a little bit different. They all have their own quirks, and they all have their advantages and disadvantages without a doubt. You get it right in the short term, very cheap, and it's highly leveraged. That can be a very good combination. But then, you can also you can be wrong for a week or two, and then your money's gone in short-term stuff. So it's like any other part of the market. I mean, it can be good, but it has its drawbacks too, shorter time frames.
Yeah. I mean, that goes back to our advice every time is everyone's unique and the market changes each day. So the real answer depends on what day you're calling.
Yeah, it never gets boring. I mean, that's why I like this. It's like a puzzle you can never quite solve, and it changes constantly. Just when you about think you have it, it's completely different a week later.
Yeah. So tell me something that you're looking at now from a speculation side or a hedging side, or maybe you have something each. Are there some markets skewed? And I mean, I'm not looking for your trade recommendation today, but there's some markets that stand out that you're keeping an eye on.
always this time of year is going to be the grains. I mean, this is the 5 weeks coming up where you're finding highs, you're finding lows. Like this is the window when things change rapidly with the weather that, of course, nobody knows, and attitudes shift, and generally with increasing volatility almost every summer comes opportunity. Last summer is exactly what I'm talking about. Nothing. And then all of a sudden, about this time last year, the concern about the dryness started and really accelerated. I think we were at a fishing tournament in Grand Rapids, as a matter of fact, when the highs came in. I was sitting by the computer, I remember perfectly. And it was that Friday, and a big reversal. But it wasn't there when we got, I think Tuesday or Wednesday we got to there, and then by Friday the market was a completely different market, rocketing higher and then reversing sharply. So you just cannot plan what the market's going to do this time of year. You try to adjust, but like you asked what I'm looking for, you're looking for these opportunities, these mispricing, the short covering that just happened in these markets. That was a big drag on the market. It's really hard to be negative on a market when they're that short going into all this unpredictable weather. Now, we saw the Commitment of Traders report. They lifted a lot of these short positions. So when you look at the open interest dropping with the funds exiting, they are closing contracts. So far this is not a strong sign. It's just people getting out of contracts, buying their contracts back, and then no new people entering it. But that can change very quickly.
Absolutely. The markets do. Well, John, it's a Friday afternoon. It was cloudy. Now it's sunny again, so it must be time to head on out. Any closing thoughts for this episode?
No, it's gonna be fun. Number of podcasts we have over the next few weeks. We're probably gonna have a different attitude every time we have it, because that's what time of year it is. There should be plenty to talk about. So that's what we'll look forward to.
Excellent. Well, if you have any topics you'd like us to discuss over these next couple weeks or coming up, or things you want to teach us about, tell us about, the email address is hedgeheadspod@gmail.com. John, leave your number if people want to call and talk to you.
Yeah, and if you have anything that you think that we're off on, or you want to hear more about, or we're open to anything. Really, there's endless topics to discuss pretty much. I mean, we have to really watch our time, because we probably could talk all day, every day. But anything that interests you, that you want to hear more of, feel free to email or call 218-731-1578.
Perfect. Have a great weekend, John. Good luck fishing, and I hope you remembered to buy a Mother's Day present.
Oh. No, we can give the garden a break 1 week until it's gone, I think.
Until it's planted.
The relief that it's out of here.
Then Farmer John can give a garden update. All right. Well, that's...
Midway through the summer, I said it died. The deer ate it.
I like it.